Okay, everyone, we're back. Welcome back, Market Heroes. We got an interesting one for you right here, a call debit spread. So, this is a very interesting trade. Obviously, a call debit spread is we're paying a debit. This is a bullish strategy and involves buying one call, selling another. Very interesting though, and I'll get to that why just here in a second. So, a call debit spread is when we buy a call and sell a call further out of the money to reduce our cost basis and cap our upside, right? So this is known as a vertical debit spread, right? A call debit spread. Now this is where it gets interesting. So obviously it's a bullish strategy where we profit from an increase in prices, but we also profit from an increase of implied volatility. So the reason that's interesting is because most bullish strategies that we entail, we profit from not only a upward prices, but we also profit from a decrease of implied volatility. However, with call debit spreads, we profit from an increase of implied volatility. The reason we profit from an increase in implied volatility is, let's just go ahead and do one. So we're going to buy the 60 delta call and sell the 40 delta call, right? The reason we profit from an increase in implied volatility is the 244 call here is about, let's see, 257, and the 248 call is about 195, right? The 247, the 244 call is going to have a greater increase of prices based off of implied volatility, right? Than the 248 price is, right? So not only do we profit from an increase in prices, but again, we also profit from an increase in implied volatility. Now, just wanting to have an increase in prices for this strategy is totally fine. However, it's rare to see an increase in prices come with an increase in implied volatility for equities, right? That typically happens in things like FX or commodities, right? So gold is an excellent example of an asset where prices go up with implied volatility going up. So it's quite interesting. So again, this strategy will work. Again, it works because this is a bullish strategy and it's happened in a bull market. However, getting the double whammy of increase in prices as well as an increase in implied volatility rarely happens in stocks and equities. It mostly happens in FX, currency ETFs, currency stocks, as well as commodities like GLD, SLV, UNG, USO, all of those stocks that are based off of commodities, right? So let's jump right in how we do it. So again, what do we do? 2003 to present, 14 and a half plus years of data, depending on when you're watching this. Every single day in SPY, we bought a 60 delta call and sold a 40 delta call, and we held until expiration. So we showed you guys just how to do that. Let's do it again real quick, right? Buy the 60 delta call, sell the 40 delta call. Pretty simple, right? We collect $2.62, or we pay, $2.62. Our max profit on this is $138, right? So it's risk one to make one half, right? That's what this trade is. And again, there are excellent times to do this, as you'll see here in about a second. So what we do is we do this every single day, and we held it into expiration. Again, this is a bullish strategy in a bull market, right? So it's going to work, right? So we're right 64% of the time for about 23.81 P&L per trade. We're in the trade for about 50 days, and we make about 48 cents per day. Now, that's pretty good. Making 23 bucks, that's pretty good considering we're only paying $2.62, right? That's about a 10% return on capital average. Again, you're not going to hit a home run with this strategy by any stretch of the imagination because your upside is capped. You have a max profit, right? Your upside is capped. However, the return on capital on spreads is really high, right? So now let's see, because again, we can expand on this. Look, 48 cents a day is great. We can expand on this though. So let's see what happens now when we do the exact same thing. First, we're going to do it every single day. Buy the 60 delta call, sell the 60 delta call to create a long call spread, right? Call debit spread. All right, so we're going to do it every day, and we're going to hold it until it expires. Then what we're going to do is we're going to buy it at 50% of max profit, right? So if we were to buy this trade at 50% of max profit, what would it look like, right? So 138 is our profit target, or excuse me, is our max profit. That's 69. That's $69 dollars, right? And then we're going to add that on the 262, right? So if the value of this spread ever got to 331, that would be our 50% management. So we go ahead and buy it back at that point, right? So let's see how different that is. Well, you can see it's obviously a pretty big difference here, right? And there are a couple things that really stand out to me. The first thing that stands out is we make more than double when we are managing our spreads at 50% of max or of our profit. The second thing that steps out to me, which we don't really see this big of a discrepancy in any other strategy, is the fact that we're in the trade for a fifth of the time. So it takes a fifth of the time to get to that 50% of max profit. That's absolutely crazy. So think about this. You get to do 5 call debit spreads where you're managing your profits at 50% in the time it takes you to do one where you just put the trade on and don't manage. So again, a lot more money, right? That's a lot more money that can be made by managing it, but we're not done yet. Again, guys, don't go goo goo gaga for this. We might not always be in a bull market. This is a bullish strategy in a bull market. So don't go crazy about it. There are definitely times to do this, right? There are definitely times to do that when stocks are down or implied volatility is low and stocks are down. It's a great time to go ahead and put on these call debit spreads, right? But again, this is a bullish strategy in a bull market. These numbers look so good for a reason. So let's take it a step further like we do with everything else. Let's see what happens if we do this trade when volatility is below its average. Remember, we want volatility to be below its average because we also make money from an increase of implied volatility, right? So this last section here doesn't happen ultra frequently. However, when it happens, we get insane results, right? We get insane results, right? So we're right 76% of the time. We make about $2.50 per day. If you guys remember, that's really high in terms of a lot of our strategies. That's about as good as selling a strangle and managing at 50%. So this is a big profitable trade. However, those opportunities where stocks are down and implied volatility is down is few and far between, unless you're talking about commodities or like an ETF for foreign exchange or currency, right? And then we're in the trade for an average of just 6 days. That is just amazing. That is just amazing. So again, you want to put the strategy on, number one, when stocks are down, because we're looking for prices to go higher, right? Number two, we're looking to do this, if we can, when volatility is down. If you guys remember, it's really tough to have equities with low prices and low implied volatility. That's very challenging to have. So like gold is something where this happens all the time. Silver happens all the time. Nat gas, oil happens all the time, right? But again, in equities, this is tough. However, those type of ETFs are there for us to trade, right? So again, super awesome strategy. Again, but just preface it with, this is a bullish strategy and it's been a bull market. So this should be nothing new. This should not be surprising that it's so profitable. However, call debit spreads, excellent strategy, big return on capital. I'll see you in the next video.